Howdy, Jacob here. Today we're looking at ChipMOS Technologies, company 75 in our dividend yield screener. Okay, so roughly $1 billion market cap, a little bit more in enterprise value. Currently a 5.6% dividend yield. All right, so net debt, very little. We see 406 million, sorry, in long-term debt, 323 million cash on hand. A very capital-intensive business. It's kind of surprising. So it looks like, um, if we look at roughly 2015 to 2019, they really didn't make any money. Um, But if we look at a 5 year average, 0, 20, 70, 60, 130, probably 50 million. And they're paying out 102 million on their dividend. So this would be a company that I would say I'm not entirely confident that the dividend will stick. I'd say a more comfortable value would be to cut it to a third of what it is, and that'd be about 30 million payout, which would bring the dividend yield down to under 2%. So it doesn't really satisfy the screener that we're really doing, but um, still fine. We can still look at the business itself. So made my dividend assumption. They're going to have to cut it to a third of what it is. As for earning, the other assumptions for actual growth of the business looks like 651 million in revenue in 2013, 767 2022. Looks like it jumped quite a bit in 2021, but then back down in 2022. So it might be a slow growing business, but it's weird. The semiconductor industry as a whole is projected to grow pretty quickly. But this is a related to assembly and testing services in Republic of China, Japan, Singapore, internationally. Okay, so given history, I might assume 3% on the revenue growth, 13 on the PE, price free cash flow, for a company that's still projected to grow a little bit, maybe after the 7 year period. And then as for margins, let's see, it looks like their earnings margin is quite a bit higher than their free cash flow margin. I don't like to see that, but it's not, as long as they're still producing free cash flow, you can't be too disappointed in it. And the free cash flow has been higher recently. So I think I'm going to put maybe 12 and 10 share change. Let's assume no share changes. It looks like they bought back quite a bit 2015, 2016, and really haven't done any share buybacks since. And they don't have stock based compensation. So their shares should remain relatively flat. And that gets us to a stock price that would need to fall roughly 40% to get to a 15% return um, on the stock. And so for now, as for the dividend yield, we already chatted about it. Since they're going to have to cut it to a third to have a roughly 30 million payout, which is more in line with their 5 year average. That's less than a 2% dividend yield. So not really what we're looking for in this particular scenario. But as for the business itself, I think that there could be some growth potential ahead, and it's really just a waiting game to get to a price that appears more attractive to me. So for now, I'm just waiting. And yeah, I hope everyone has a beautiful rest of their day. Thank you.